Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, December 8th, 2023. It's 9:50 a.m. Eastern Time, so we're starting the video, so we're a little less than an hour and a half into the trading day. And I wanted to just get a relatively brief update, but add a few things on, some developments to watch for, some things I'm noting with the kind of ties into the big three. That's what I'm going to go over here, but I want to put a little bit more focus and show you a few more things on bonds that I haven't showed you yet. So yesterday, if you recall, shorting bonds. Everything from Treasuries and corporates, both investment grade and junk. I put out the junk one yesterday, investment grade very much so, and I could even see investment grade fall as much as, which is unusual, but as much or more than junk bonds. Again, that would be really, really unusual. Let me get into that in a minute when I get to LQD, the investment grade corporate bond ETF. I'm starting out here with VTI. I've shared this in the past. VTI, it's the Vanguard Total Stock Market ETF. You can look it up. It tracks a certain index that is probably, from what my understanding, the closest thing it is, as the name implies, to the total stock market. For those not familiar, when you trade the S&P 500, those are 500 of the largest companies in the U.S., ultra mega caps. It is not the stock market. In fact, there's a lot more mid and small cap companies. So keep that in mind. The NASDAQ 100 is the farthest thing away from even being, it almost shouldn't be called, it is an index. An index is when you compile a bunch of stuff, but I've talked about it. It's 100 largest in the NASDAQ 100, and it's super overweighted to the top Mag 7. Even the S&P 500 has a overweighting of the Mag 7, but not as bad. Anyway, this is just, again, an idea to get what the entire stock market's doing, small, mid, and large. And I'm going to talk on what I've been talking about a lot lately, the bearish PPO crossovers is a super simple. I mean, again, it's one tool in your toolkit. It's like the screwdriver or the hammer. It's a good one. It's not the be-all, end-all. And again, I use it in conjunction with other things. So I'm just going to highlight what I did real quickly. I marked up all the bearish. Now, when I say all the bearish PPO crossovers, any little whipsaws, like this is a little whipsaw, you had just the slightest cross aboves. You want to look for these hills. And the bigger the hill, the more significant, I call them hills, big green hills, the more significant the crossover. So you can see I did it as clean as I could. And I'm just going to show you what happened after each one. This is since the bear market started right here. The market peaked back in some indexes, including the NASDAQ, peaked in November. They make effectively a double top high around the beginning of the year. But again, if you just on that alone just took a short each and every time, you would have made I'm showing you this one came kind of late in the drop, but still there was more drop to come. I'm just arrowing down. Again, you can see the crosshair, put the vertical lines. That one you would have maybe been shaken out. And again, it's not a standalone for me, a standalone buy and sell signal. I use it in conjunction with trend line breaks and other sell signals. For example, right there, you would have had a trend line that hadn't yet broken, but broke right there. All right, so you get the point. This one didn't really give us much. There was a little sideways action. You didn't get smoked by taking it, but you ultimately would have probably got stopped out before hitting a target. This one too, that one didn't do much. But you can see, again, I always say this, there's not any one indicator that's 100% effective. If there was, we would just all be using it and setting it on autopilot so the computer would buy and sell for us, and we'd be going out and deciding which island in the Caribbean or Mediterranean to buy would be our biggest problem. So that's that. And look, we just got one yesterday. Let me zoom in so you can see the history again since this bear market started. It's pretty damn impressive in my opinion. That's a high success ratio, and we got one yesterday. That's a daily close right there, meaning the PPO made a bearish cross, and it's under today on VTI. So that's that. Let's get into the other stuff. Let's go to bonds. We start with TLT. That's Treasuries. Let me backpedal in case you missed it yesterday. Let me just backpedal and go over the sectors. Remember, I gave you trend lines that I think have a decent chance of doing the trick. Again, I'm showing you things to watch. I think it has a good chance of doing the trick, but I'll watch if and when we break those. And what I'm talking about here, I want to see the vast majority break, ideally in close proximity. Some of these have already broken below. So there's XLK still above the near term. I'm talking about the most recent uptrend lines on these charts. Again, I covered these in yesterday's video. XLV, very close, right up on the trend line now. XLF, and I'm going through these sectors in order of market cap, so the most it's significant I'm covering here first. That one already broke. It's not a super clean trend line, and I talked on some of these trend lines are cleaner, if you will, more reactions than others. That one's below already. XLI kind of below. And some of these that I have that breaking down and back testing, like I said yesterday, you could do this, and I very well may do that to the other ones that way. Because now you have a different reaction points. You have 1, 2, 3. So that's actually a valid trend line. Let's just leave that one there for XLI. And since I didn't have an alert because I already had it breaking down, I'm going to set an alert. And what I like to see, and I've been doing this a long time, when I'm trading a sector, if it's gold mining stocks, pot stocks, semis, what I've noticed for those sectors, and in this case, we're talking the broad market, but when you have a lot of correlation between the individual components, and let's say it's the semis, and I have NVIDIA and Qualcomm and Intel and Texas Instruments and Taiwan Semi, and all of a sudden I have I have price alerts set over on trend lines or horizontal support key levels, and all of a sudden on one single day or within 2 or 3 days, I get boom, 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 these alerts going off like popcorn. That tells me it's not one, but the majority of the key semis breaking down, and that gives me confidence to then short the sector as a whole, whether it's the ETF or add to the individual semis. Same thing here, because as I said yesterday, an index, in this case the S&P 500, is simply a sum of its parts. So the more of those parts or sectors I see breaking down, especially the big important ones, the more likely that breakdown is to stick. So here's XLC, XLP right on the line. Again, I have a lot of these right on the line. Energy already, it's doing its own thing against the grain. XLU, there it is, XLB, and XLRE. If I didn't say what they were, I'm sorry. You could. All right, so I didn't want to spend too much time because I covered those yesterday. However, here's where I wanted to update you on. Let's go to the bonds now. Okay, so we know, I think I'm going to move this over here. Bearish and short bonds after being bullish and long throughout that. Even in, remember I told you back here, I made a rare move of putting a very large portion of 401k long-term money into bonds and rode that up. Took a little bit of profits. Where was it? About a week or so ago, maybe 2 weeks ago when T1 was hit. Told you took off about, I forget what it was, a quarter, maybe no more than a third. No, it was about a quarter, I think. And yesterday pulled off a bigger part. Now I'm only back down to about a quarter what I started with, because to me, I think I milked all or most of the initial leg up in Treasury bonds, and so I'll probably get back in. I'm still intermediate term bullish and longer term bearish on Treasuries, but that doesn't matter. I mean, that's right now my thought. I'm looking out today, tomorrow, next week as a swing trade. So either way, short, hit that. Remember I gave you a potential for swing traders, T1 and T2, the trend line. So all my targets were hit on TLT. That T4 zone up here between 95 to 95, 6, 70-ish, and the downtrend line. So far, so good. 1% pullback in TLT. Nothing to get excited about. Oh, and I'll loop back to what I'm getting to. But by the way, just somebody pointed out, and I don't know, I had a brain fart yesterday. And it's probably because in recent years I've been trading more and more futures. But back in forever and a day, when we were to short the long bond, I would often mention, because I know a lot of folks can't short, or they're trading an IRA or a non-margin account, or just don't even know how to do it. You can short TLT, it's the pure play, or you can buy TBT. That's what I've usually used. It's the 2-time leveraged 20 to 30 year bond ETF. So opposite of TLT, minus 2. 2 times. And then, but I put out there TBT and I referred to it as, it's the same thing, same company, it's just 3-time leverage. So very important you recognize that and beta adjust accordingly. The beta adjust meaning, you're 3 times. If you're going to short $50,000 of TLT, or let's say, well, we use a round number 100,000, then you only need to buy about 30,000 or 35,000 of this to equate for that, because you have a 3-time leverage factor in there, right? Okay, so and it's up, 3% today, but again, that's adjusted with leverage. But also, as the other TLT trade, remember, bonds, and especially Treasury bonds, are inherently a lot less volatile than stock markets. So you still have, at the core, TLT is generally a 2-time double position size for me. And again, what does that mean? Well, on SPY, if whether your number is 5,000 or 500,000 when you make a trade, doesn't matter. It's on a stock like SPY, a stock ETF, or a general broad market ETF. If your number is 10,000 on SPY, then you would want to trade ideally around 20,000 when you go into TLT. Because of the lower volatility, above average or below average gain and loss expectations. You're either going to lose, in percentage terms less if you're stopped out, and you're going to make in percentage terms less than you would on a stock trade, and therefore you can take a larger position size. Okay, I think that's pretty self-explanatory. Nice reversal so far. Stocks not getting the memo, and that's what I wanted to see. That was my prediction. That's come to fruition so far. This is yet another day. This is QQQ. Is just flipped negative right now. Was positive a second ago, but SPY up 0.13%. VTI, let's just look, kind of everything is up about 0.23%, and yet bonds are down. That's one of the biggest days in a while. It is the biggest day in a while. A 1% drop in TLT. Even the 10-year is down 0.6%. So this is what I'd been looking for, and again, I always say one doesn't make a trend, but now we have about a string of almost a week close to it, a majority of the days where there's been a complete and utter disconnect between that hypersensitivity and very strong positive correlation between bond prices and the stock market. Stock prices both were going up because yields would go down, and that would make stocks go up. That's disconnected. Now, do I like it, the fact that bonds are, yields are finally rising, and I'm seeing stocks go? No, but the stock market's really gone nowhere. It has these up days recently. Either way, all I'm doing now is highlighting that we're seeing that less hypersensitivity, and I can all but promise you. Well, I can't promise, but I can all but promise you, if I am right and the correction on bonds is going to be deeper, meaning rates are going to go higher, promise you the market's going to recognize that sooner than later. Right now, they're just dismissing it as a few, one-day kind of aberrations here and there. But if that continues, I would be not surprised, almost shocked to see a correction to the scope I'm calling for right here. For IEF, for example, down to 92.55, and not see the stock market go down to. And I think it can freak out a little faster than most think if that starts to happen. I've seen this before. They don't get the memo. Stocks don't get the memo when the euro is dropping or the bonds are dropping, but then they finally do, and they play a pretty nasty game of catch up. Okay, what I wanted to do in this video that I didn't cover yesterday, so I put up some trend lines. The 10-year, you've heard me say, is probably the most significant bond to watch by the financial markets, including but not limited to the fact 30-year Treasuries typically track the 10-year. 30-year mortgage rates track the 10-year. And so, what I noticed and didn't point out yesterday, but you have a very similar uptrend lines that are similar in scope, duration. And again, this isn't mere random coincidence either. Remember, that's when rates bottom. That's when we went long. We were long equities, covering all shorts there. At least that's what I posted and recommended or suggested, did personally. And that was the catalyst for the stock market rally. So it's not just random coincidence or some odd thing that you have comparable trend lines. So what I showed you yesterday on those sectors, that if they break here in Treasury bonds, it's pretty well watched, especially on the 10-year. We're right on it now. So this is what I wanted to show you. These bearish PPO crossovers, look, there's a high level. It hasn't happened yet. But the last time we had a high level, bearish PPO crossover around here was right here. I'm going to take that line up. You can see the crossover. I took the histogram away. what what would you wanted to do if you could go back in time? Well, you can look at it. That's what happened. I'm not saying that's going to happen that much, but I'm saying these are pretty damn reliable. Here's the previous high-level bearish PPO crossover, actually, yeah, right here, and that happened. And the time before that, it came. I can see it closely. I moved the histogram away. You can do it yourself. Put a histogram up, but it finally crossed right here, and then that happened. Okay, had to pause the video there. I had a distraction, and trying to remember where I picked up left off, and I believe it was right here. So there it is. So you can see IEF, you have a clean up trend line. TLT, we're a little bit above it. Remember, I had on that 60-minute chart this price channel right here with the blue line, which is also the minimum target. I guess we're about halfway there, with the drop today. But there's the uptrend line. So point being, if these uptrend lines, again, IEF, the 10-year, that's the 7 to 10-year Treasury bond ETF, is right on that line now. TLT has a little way to go. And yeah, it's somewhat incremental. Again, I take it all collectively. If you see the majority of the sectors break down, especially bonds, I can all but assure you, again, I can't guarantee it, but all but assure you, if we get this, we hit that target, which is what I favor. I think we're going down there. The stock market will respond. Right now, it's in that Santa rally mode. I've seen this kind of market. These divergences just keep going, and they don't play out. The market, it's around the holidays. You don't have a lot of short sellers in the market right now, but this is what we'll watch for, and it's hard to say if it's going to happen by the end of the year or not. Again, typically I've noticed historically there's a drift up in the last few weeks of December. It also makes for tough trading. The market will chop you up, low volume trading. A lot of folks are on vacation, so you get these kind of swings that are almost unpredictable. And it's, for me, usually a time that I take off or at least cut back on my active trading. But like I said yesterday, I mentioned, never, always being prepared, just like in war. You never rest too much. Always keep keep a sentinel on watch and keep an eye out for what may happen, because this could happen any day now. And again, we have the levels to watch. So whether that's today, tomorrow, next week, or it never happens, there it is. So this is how we trade. This is what I think will ultimately, if it happens now, bring the stock market down. And if it doesn't, and we hold these lines and bounce here, and IEF, like I just showed you, that's a 60-minute chart. There's a daily chart. And then all those sectors in the S&P 500 that I showed you, if they hold those lines and bounce, well, then we're probably going to continue to drift higher into the end of the year. All righty. The other things I wanted to show you is I gave you I think it was HYG yesterday. There's two junk bond ETFs, or at least the two most popular, I should say, the ones that I've been watching for years. And first to market, I believe, is JNK. That's the Spiders Barclays High Yield Bond ETF. And just like HYG, they're both, they're going to marry each other. They're just different ETF companies. Big resistance there. You can see this trading range that we've had for over a year now. That's a big old range. You had this one period we were down below there. There was October lows. Again, no mere coincidence. Interest rates bottomed or peaked. Remember, bonds are opposite. Peaked back in mid-October, and that's what was the fuel for the stock market rally. Then we had this recent other peak here. And again, this was the catalyst. Again, it was every bond fund I track, all the bonds set up with that positive divergence. So like I said, hopefully some of you capitalized on that. It was the biggest bond rally, they say, in I forget how many years. And of course, nice stock market rally as well because of the falling rates. But that's where we're at, guys. We're at resistance. My point is not just on the Treasuries. We didn't just hit the target that I gave you on TLT. We've hit major. This is not little resistance. This is, to me, big. A lot of reactions here. In fact, all throughout the year, other than this one brief period where you had this, we were above there with that divergent high. That's capped every advance here. Now, look, a breakout there would be bullish. So I've always said this: if you're on the other side of the trade as me, you're bullet. You think bonds, this rally has a lot more to go before we have a meaningful correction. Then the levels that I'm showing you are levels that you, as a bond bull right now, waiting to add more or buy because you missed this rally or whatever. Pop above. I have it at 92, 91. You're going to call it 93 to be safe. Absolutely, that's what I would do. And then, is it going to be a false breakout that fails? Who knows? But it's easy when if that's where you think things are going, then take it on face value if it breaks out, and then just set your stop a little bit below in case the breakout fails. Now I'm on the other side of the trade, so I'm short bonds here, and if they go and break out, then that's where my stop's going to be. So it's kind of like looking at it in reverse. And you can see here, I didn't do it yet, but I'm going to do it now. You also have these uptrend lines forming. Whether you want to come off the lows there, that's probably the best. Yeah, that's probably the best draw for JNK. And then HYG, I already have one here. That's the one I think I posted for yesterday. Look at all these reactions there. That is super technical. Oh, and look, on HYG, even better. So junk, I showed you we were at the resistance. This one actually just broke out. And what I suspect, because you can see I have this uptrend line here, I'm going to draw a BOD trend line right now. It's what I refer to as, I call it a benefit of the doubt trend line. Let me see how that looks. Yeah, okay, I'm going to leave it there. What I'm doing on that one, I'll color it up a little different so you can see it. I'm coming off the recent lows instead of that candle right here that the other one connected. So this one was on the low back there. There was a bullish engulfing candle on October 23rd right there. And that one we're right on right now. So this would be even better because you have a breakout, right? So for those that don't look at JNK and don't look at the rest of the bond market like I do, and all the treasuries, corporates, high yield, investment grade, they're seeing this breakout. And they're not looking at everything else at resistance. So in my opinion, this breakout fails. And then that's going to be even more bearish. Why? Because a failed breakout, I always say that fewer things are more bearish than a failed breakout. And the reason is they call it a bull trap, because longs will pile in for the reason I just told you a minute ago. You broke above resistance. Shorts get stopped out because they have mechanically have a tight stop or a stop right above resistance in case a breakout occurs when they shorted the first move up to that level. So then two things happen. The longs that took the breakout, their stops are here. They realize they're wrong because the breakout failed, so they sell. And then the short sellers have already been cleared out, and that sets the stage for a bigger drop, because when you have too many shorts in any security, I always say they're the only guaranteed buyers. They tend to, on pullbacks and drops, they start booking profits. And that's when a short takes a profit or closes a position, they're actually buying the security. You buy to cover. So you get the double whammy there on a breakout, false breakout. Hasn't happened yet. There's your trend lines. I just wanted to point those out. And then the other thing I wanted to mention, because I didn't yesterday, but I have in the past, I've talked about, and this goes back for the last couple of years I've read, and I don't know the latest stats, but a massive, really, I believe it was an unprecedented issuance of investment grade corporate. I don't want to go too far. I wanted to get this video out to you, but give you a quick crash course. AAA are your highest rated bonds. AAA ratings are reserved for very few corporations. I don't know where it is now. When I used to be a stockbroker, I think there were 7 at the time. GE was one of them. There were just a handful of companies that commanded a AAA rating from the agencies and the U.S. government. U.S. government debt was normally, and a couple times they've been downgraded. And then it goes down the line, double A, single A, and then you go to B, triple B, and then so forth and so on, double B. And there are, these are different agencies. Some have A, A plus plus, different ratings in there, but this is the main one. So anything triple B or above is considered investment grade. And anything double B or below is considered below investment grade, aka junk. That's what the nickname is, junk bonds. And then you get down here, you get the C ratings lower. D is in default. If a bond has a D rating, it's based, they're not paying. They stop paying interest. They don't have the money. All right. So, okay, where am I going with this is, and again, this may not happen by the end of the year. It may not happen in 2024. I'll bet it will. But what happened is a huge amount of issuance in recent years was at the lowest tier of investment grade. And so, well, what does that mean? Well, it actually means a lot. And I made this call back in, when COVID hit, and we had a huge short and profitable on this, because there are a tremendous amount of mutual funds. I don't know if you're familiar with this, but the bond market's bigger than the stock market. There's more money in bonds than there are in stocks. It's a larger market. And what happens, a lot of these this is an ETF. You have also a lot of mutual funds out there, and these mutual funds and these ETFs, they have a prospectus, rule that governs what they can and cannot hold. And this one, I haven't read through this one particular, but for the most part, as the name implies, they have to hold investment grade corporate bonds. And a lot of bond funds are the same way. Other bond funds will allow to hold junk. Others specifically focus on low grade, high yield bonds. Okay, here's my point. So by prospectus, all of a sudden, if the economy starts to roll over, especially if it's a fast rollover, not a slow roll, and you get a lot of these companies downgraded, that huge tranche that's sitting there on the lowest credit quality, the triple Bs, triple B minus, and they get knocked down, then whether they want to or not, the massive amount of corporate bond funds or bond funds as a whole that will state by prospectus they can only hold a certain amount or no junk bonds or below investment grade, or they can only have a certain period of time to get out of it. It's just a domino effect. At once they all hit, these ones start getting downgraded. LQD and all the others, all the tons of bond funds out there and 401ks and everything, they have to sell by prospectus. They can't hold, pray, and hope like retail investors. It's called buy and hope. They buy something, it starts going down. They just hope that the Fed will bail them out, the market will bail them out. And a lot of times it does, sometimes it doesn't. These guys aren't allowed to. They would be a breach of fiduciary. They have a fiduciary responsibility. It's their job. They could be, I don't know, personally sued. You have to do it. The fund manager has no choice. If he says you can't hold junk bonds, can't hold junk bonds. And you sell at the same time everyone else is selling. And and that's what happens. And if you want to see what happened last time it happened, it was right here, and we shorted that, and that was LQD. And this was an unprecedented drop in corporate bonds, because all of a sudden there was a rapid change, and everybody was a rush for the exits at once, and corporate bonds dropped 22% in a matter of weeks or a couple months there, and spitting out a little paltry yield of 4%, whatever it was. Those investors, especially those that spooked out at the lows, they'll probably never recoup that money if they sold out the lows. They're still, and look where LQD is, it's still below there. So what I feel sorry for the poor suckers that bought here. They're still underwater, and they'll probably, I can say with a high degree of confidence, they'll probably never see that again. You'd have to go back to a zero rate environment. And the only way we're doing that if the economy just completely craps out, and there you're probably not going to see corporates go up. You might see treasuries run up. But anyways, I'm digressing now. All right, you get the point. Is that this one looks ripe for a short as well for those things. A lot of people probably are, I think, especially a lot of the young pimple-faced, guys and gals coming out of, Wharton and all these business schools, and they haven't been through these cycles before, and especially nothing like, I'm looking at a bear market that doesn't look like anything we've seen in the past half century, and I think that's where most people are going back and probably comparing the previous bear markets. All right, guys. And then look, the end of the day, this is again what I wanted to point out. Just these uptrend lines mirror, they're very well defined. Look at especially LQD, and look, LQD just broke down. So this is one to watch. Whether you want to trade bonds, whether you want to short bonds or not. If you short bonds, you pay the dividends. A lot of people don't like shorting bonds, but keep that in mind. Is that this one has broken down. I have IEF right on the line, so maybe not an all-in moment or anything like that. Where to? You can see my sole target would be the intersecting downtrend line in 105.30, and that would be a spike in yields, and that would most likely bring the put pressure on the stock market. Okay, I told you I'd keep it relatively brief, 30 minutes, kind of briefish compared to a lot of my videos, but there it is. And watch those things. Watch for the trendline breaks. Watch for the bearish PPO crossovers. Watch equities. Watch the sectors in the S&P 500. And like I said, maybe we don't get those. And if we don't, then no reason to be aggressively short equities. Or even bonds. Bonds I like because, like I said, the reason for putting those shorts on yesterday was shorting at resistance, and you start getting the breakdowns in LQD, which we have now in IEF. That would be a reason to add to that position. See, there's IEF right there. Add to your bonds, and TLT is comfortably above there. But again, we had more juice. TLT carried higher. That's why we're in TLT. And if that one breaks, that's going to also be bearish. Alrighty, I'm going to wrap it up here, get the video out to you guys, and let you decide what to do. This has been Randy Finney with Right Side of the Chart. Have a great day.